So now, as I said before, we discussed about currency and forex risk, mitigation strategies, how the CBK or any Reserve Bank. We looked at an hypothetical situation of the mix of forex currencies, for example, holdings or portfolio of an hypothetical bank. We used the JP Morgan Chase, and how the central bank and also the Treasury Department of that bank was able to come in to not only monitor but also to calculate the, for example, the portfolio VAR, and then now to we also the, for example, the risk mitigation strategies that they could use to be able to mitigate such forex and currency risk. So that now I want us to now look at capital adequacy and now the regulatory compliance by reserve and commercial banks and also even central banks as regarding capital adequacy. And basically that's all to do with the Basel III requirements and the ratios, for example, the capital adequacy ratios that are uh, that are based under the Basel III requirements. And then we'll also see how to optimize the capital efficiency and also do some a little bit of stress testing using worst case scenarios and also scenario analysis and sensitivity analysis. So capital adequacy is basically the fact that or the requirement by central and reserve banks that banks are required to maintain sufficient capital and in cash and cash equivalents, reserves, and enough capital buffers that are unable to that enable them to be able to absorb losses and also be able to take care of their short-term obligations, but also even handle emergencies like a surge in withdrawals or market crashes. Okay, and this is basically enforced through a framework called the Basel III framework, which is basically a banking framework that was established. It's a global framework that was established by a committee called the Basel Committee on Banking Supervision way very long ago, and it's basically the framework that guards the capital adequacy requirements that is imposed by reserve and central banks of Kenya and any other country regarding, for example, their capital adequacy, regarding their liquidity ratios and also liquidity coverage ratios and also net stable funding ratios. So to see, we've talked about Basel III requirements before, but now we'll just try to go deeply into it and also look at the its implications and also the regulatory implications of the Basel III capital adequacy requirements by central banks and reserve banks on commercial banks. So the Basel III capital adequacy requirement is basically it says that, as I said before, that banks are supposed to maintain at least 4.5% of their risk-weighted assets as CET1, that is Common Equity One. Eh, Common Equity One is the first round of funding that any company, but in this case we are talking in the context of banks, raise, and it's basically to ensure that the bank's financial or their overall financial statements reflect that they are able to be at a good financial standing to be able to absorb any losses. Okay, and what does CET1 entail? You mentioned that it's a common equity, and basically just common shares, common equity, the same thing, and also retained earnings. That's CET, and these are basically retained earnings. These are basically considered to be HQLA, means high quality liquid assets. And so the Basel III requirements it mandates and it requires commercial banks to hold at least a minimum ratio of 4.5% of their CET1 in terms as a ratio of their risk-weighted assets, as a ratio of the total assets, but now the risk-weighted, they have to be risk-weighted. So basically, what that says that the CET1 is basically the CET1. Now, for example, the retained earnings plus the high quality liquid assets, the other retained earnings common shares, CET1 over the risk weighted assets. Okay, so this ratio, whatever ratio we will find here, it should not be 4.5% below. It should be 4.5%. That's the Basel III requirement, basically. Whatever ratio we get from adding up the common shares and retained earnings of a bank's balance sheet and also statements of financial position as a ratio of the risk-weighted assets, or as a ratio of their total assets, should not should not be less than a ratio of 4.5%. Okay. Yes, meaning, so as we have said, the ratio of the CET1, that is common equity one, that the first round of funding that banks and other companies raise, it can include retained earnings and common equity or common shares. Okay. And also there is a second component of the Basel. We have been talking a lot about that only that one requirement pertaining to Basel 3 requirement, but there is usually a small disclaimer to it. There is also the total capital ratio requirement of the Basel 3 requirement that also includes that the CET1 and plus the additional tier 2 capital, and also even the additional tier 1 or additional tier 1 capital. So CET1 common equity 1 capital and the additional any additional tier 1 or capital plus additional tier 2 capital T2 we can raise. So CET1 common equity 1 capital, additional tier 1 capital, and tier 2 capital, it should be not less than 8%. That ratio should not be less than 8% of the assets of that bank, or of that reserve or central bank. So meaning that can easily be translated to say that the total capital ratio of any bank as required by the Basel III framework, that it should be that CET1, the common equity T1 plus any additional tier 1 capital that the bank may raise plus the tier 2 capital as a ratio of the assets of that bank should not be 8% and below. It should be 8% and above. Okay. The other rejoinder, or the other disclaimer to the Basel III framework also, that there is also a capital conservation buffer, that banks should be able to retain a capital buffer of at least 2.5%, an additional 2.5% in addition to the CET1. So in addition to maintaining at least 4.5% of your risk-weighted assets in the form of CET1 capital, you should also uh, retain at least 2.5% as a capital conservation buffer. But that is usually during stress testing, especially during extreme market scenarios. Okay, especially for example, if an economy is undergoing some free period, banks may take advantage of falling interest rates and lend, or rising interest rate and lend and let uncontrolled, then that requirement is to curtail them from excessive lending. Okay, because banks can just be lending and then increase their risk, which now the central or reserve bank of any country now comes in to curtail them. So in addition to the total capital requirement, the CET1 requirement, as in the Basel III requirement, there is also the counter-cyclical buffer and also the capital conservation buffer. That is also it's also enforced to prevent banks from excessive lending. And it's basically all that is designed to make sure that the banks maintain a strong base, especially during periods of economic downturn. So the usual Basel III requirements are only the CET1 requirements, are all the total capital requirement, but the capital conservation buffer, and also the counter-cyclical buffer are only during extreme, especially for example, market downtime, market crashes, and also when there is credit expansion, when banks are lending too much, they there is a Basel III requirement that also requires them to maintain an additional or retain an additional 2.5% of their CET1 in addition to the CET1 capital as a percentage of the risk-weighted assets to prevent them from excessive lending. But as I said, those ones are usually can be can be tweaked by the prevailing country central bank, or there are any regulators, for example, the Treasury Department or the Treasury Cabinet Secretary, things like that, or the Monetary Policy Department of the CBK or the RBM. Okay, but I'll give you a condensed exact requirements of those Basel three, those four Basel three frameworks. Okay, so I want us to look at an hypothetical Basel three requirement of let's say the National Bank of Malawi. So let's say the National Bank of Malawi has 10 billion, 10 billion Malawian kwacha in assets. That's the asset, the total assets of National Bank of Malawi for the year ended 23-24 is 10 billion. Then for them to meet the Basel III requirement by the Reserve Bank of Malawi, then they need to maintain at least 4.5% of that 10 of those assets as foremost in the form of CET1. That is comprising of retained earnings and common equity. So 4.5% over 100 times 10 billion, that comes to 450, right? 450 million Malawian kwacha. Should they maintain 449 million Malawian kwacha, then the National Bank of Malawi will be going against the Basel III requirements as enforced by the Reserve Bank of Malawi. But as we have said, there are additional rejoinders or additional disclaimers to the Basel III requirements regarding the total capital ratio and also the capital conservancy ratios. Okay, so let's look at still an hypothetical release or disclosure by the National Bank of Malawi that has 10 billion in weighted assets. Okay, let's say their common equity one, CET1, is 600 million. Let's just out of the 10 billion Malawian kwacha that they have, let's say they also have 600 billion, no, million. It has to be 600 million Malawian kwacha in CET1. Okay, and then let's say I want us to be able to demonstrate the other three Basel III requirements. Also, we said that also there's a component of any additional Tier 1 capital that the bank may raise. Let's say they also hold at least 100 million in Malawian kwacha MK in Malawian kwacha in form of additional Tier 1 capital. And then also let's say any additional Tier 2 capital. You know, there can be many rounds of funding in a company or in a bank, right? Yeah. So the Tier 1 capital, any additional Tier 1 capital, and then Tier 2 capital, and so on and so forth. So let's say also in Tier 2 capital, T2, can denote 2 capital, let's say also 200 million Malawian MK, Malawian kwacha. Then therefore, let's see how we can see if really this bank, the National Bank of Malawi, is complying with the Reserve Bank of Malawi's Basel III regulations on the minimum CET1 and also on the minimum total TCR, total capital ratio requirements. So, as we have said, the Basel III requirements requires that at least 4.5% of the total weighted assets or total risk-weighted assets, that is the assets that they have, the 10 billion, at least 4.5% of it has to be in the form of CET1 capital, common equity one. Therefore, as we have said, their CET1 is 600. So let's say, so it should be at least 600 of the 10 billion needs to be at least 4.5 or above. Yeah. Should it be below 4.5, then the National Bank of Malawi risks sanctions by the RBM. So 600 divided by 10 billion. So that's like 10,000. No, 600 M minus 10,000 M, isn't it? Over 10,000 M.
600.
Okay. 600,000 divided by 10 billion. That is like 10,000 million and 600 million, right? Yeah. That comes to 0.006, which is 6%, right?
Yeah.
6% is above 4.5. So hooray, the National Bank of Malawi is compliant according to that one Basel III requirement on the CET1 capital, that the minimum which they are required to maintain 4.5% of the risk-weighted assets. Okay, then let's say if they comply with the other requirements of the Basel III RBM requirements. So it also says, as we have said, that the TCR, the total capital ratio, should be additional tier one capital. So that is CET1 plus CET. Any additional, okay? So that is 600 million plus additional tier one capital, that is 100. The ratio should be, did we say it should be above 6%? Did I tell you that?
6.5. Uh, you said it has there is something about 8% when it's tier 2.
Yeah.
Then you said 2.5% in a stress kind of scenario.
Yeah, in a stress scenario. No, those are the other two ratios and requirements are during scenarios, especially market downtimes. That's why they can even be easily tweaked or changed by the national regulators.
Okay.
Yes, but the additional Tier 1 capital, in addition to the original CET1, Common Equity Tier 1, the ratio should be at least 6%.
Okay.
Yeah, so 600, we said that. So they had CET1 600 and then additional Tier 1. The ratio should not be less than 6%.
Okay.
Okay. So let's write these rules down. So the first rule is CET1 should be 4.5% of times assets. Okay. So it is greater than. Okay. And then two, any AT1 plus the CET1 should be above 6%. So CET1 plus additional Tier 1 AT1 should be equal to or greater than 6%. So let's calculate. So 600 million plus 100 million, that's 700 million, divided by 10 billion, that's 10,000 million. That comes to 700 million over 10,000, that's 0.0, that's 7%. 7%. So that 7% is above 6%. So they also comply with the second Basel III requirement. Okay. Let's now go to the total capital ratio. So now the total capital ratio is now all the capital that they have raised, so in the Tier 1 and also the Tier 2 plus the additional any Tier 1 capital. The ratio should be at least 8%. That's what we said. So we said that in the Tier 1 they raised 600, in the additional Tier 1 100 million, Tier 2 600 million. I mean 200. So that all comes to 900, right? 900 million over 10,000 million, that is 10 billion, which was the total risk-weighted assets of the National Bank of Malawi. That comes to 0.09, which is 9%. Therefore, it's above 8%. That is, so they also comply with the term. Okay. So the TCR requirement should also be equal to or greater than 8%. Okay. So the total capital in the Tier 1 and Tier 2 plus the additional should be not less than 8% of the assets. So they also comply in that case. So in that case, we can be able to see any bank's balances and releases and disclosures to be able to see. One, we look at their say Common Equity 1, any additional Tier 1 capital they raise, and the Tier 2 capital. Those all at this stage should comply to the each and every level of the Basel III capital adequacy requirements by the Reserve Bank of Malawi or any capital or any central bank for that matter. Okay.
What?
I think they'll bring so hot. I'm complaining it's hot and I'm on my jacket. Okay. So then let's look at how some of the other also hypothetical scenarios where a bank was maybe another scenario where a bank was able to comply or not with the Basel III requirements at each stage of and then we'll also look at the other two requirements that I informed you, but those are usually not mandatory. They're usually just enforced during, for example, when a bank is undergoing distress, as I said, during stress testing, or during economic downtimes, during market crashes, things like that. That is the capital conservation buffer and the counter-cyclical buffer. That is the counter-cyclical capital buffer. So we can also just employ the capital we'll all see even a few conservation buffer and also the counter cyclical buffer. Okay. And you remember, as I said, the capital conservation buffer is only during market downtimes and also when the bank is undergoing distress, and the counter-cyclical buffer is only during things like, for example, during capital expansion to discourage banks from overlending. Okay, and therefore, to reduce their risk exposure, especially interest rate risk, and also the other types of credit risk, default risk. I mean, credit or default risk, and also the forex risk. Okay, so let's try to look at to do stress testing. Okay, let's say a new balance sheet of the National Bank of Malawi comes, and apparently now the total assets of the National Bank of Malawi rises from 10 billion to, let's say, 12 billion. Okay, what will now this National Bank of Malawi still comply with? Because the Treasury Department at that bank, at the National Bank of Malawi, will have to recalculate their risk-weighted assets and then look at their compliance to the capital adequacy ratios of the Basel III requirements. That is the CT1 requirements, the CT1 plus CT requirements, of the TCR requirements, the capital conservation buffer requirements, and also the counter-cyclical buffer requirements. Okay, so in this case, we can even go back to where we were and just substitute the 10 billion with 12 billion, where we divided 600 million by 10 billion. Let's say 600 million still, because the common equity one hasn't changed. It's only the risk-weighted assets, the assets that has changed. So 12 billion, that comes to 600 divided by 12 billion comes to 5, right? Six, because yeah, 5. Yeah, 5%, 0.005, because half 0.05, so 5%. 5%, 5%, is it above the minimum that was 4.5? I hope you have written the okay, but don't worry, I'll send you the notes too. Yeah, but the first requirement, CT1, should be above or equal to 4.5%, but ordinarily and ideally for above 4.5%. So in this case, when their risk-weighted assets increase to 12 billion Malawian kwacha, then their CET1 ratio comes down. From, it was not originally 6%, it now comes to 5%. 600 divided by 12 billion. That comes to, meaning their CET1 is coming down. Meaning their Treasury Department needs to be very, very very keen, but they are still on the safe side, right? They are still well above, not even well above, just a few percentage points above the minimum required, 4.5%. But it indicates that it has now less CET1 as a fraction or as a ratio of the risk-weighted total assets of the National Bank of Malawi. And then similarly, we just do the CT1 plus additional Tier 1 and also the TCR, the CT, the total capital TCR, total capital ratio requirement. If we do, for example, now where we did 700, additional Tier 1 was 100, so plus the 600 CT1, that's 700 divided by now 12 billion, 12,000 million. 700 million divided by 12,000. So 700 divided by 10,000, really. That comes to
0.07 somewhere there.
just a minute. I went to go one side.
Okay. Oh, it's working.
Yeah. Now let's continue. Okay. So now 700 divided by now 700 million divided by now 12,000 million. That comes to just a little above 5%. It can be more than 6% also. Since it's so we are only the 600 is coming to 5%. So just add 100 to come to 5 point something.
Zero. Yeah, 5.8.
5 point. So now,
3.
yes. So now the second Basel 3 requirement of CET1 plus 81 should be more than or equal to 6%, comes to 5.83, meaning this bank is not complying with the second Basel 3 requirement. Okay.
Yeah.
So now the National Bank of Malawi's Treasury Department needs to put in place measures, for example, reducing their risk-weighted assets or increasing their common equity one. Okay. Or
Which is not
increasing
easy. Maybe
exactly.
they shouldn't pay a dividend.
But in fact, we'll exactly look at that.
Okay.
How banks now can be able to get themselves out of distress. In fact, for the first time in, I don't know, in 20 years, in a long time, one of the major Taiwan's, the biggest bank in Kenya by assets, KCB Bank, failed to pay their dividends. In fact,
That
not
could be
could
these
be. I
issues.
was there, and it's exactly because of that. I'm there, I know. It's exactly because of that. Okay, they wanted to maintain their capital adequacy ratios. Okay, but they resumed. They paid the next media dividends. Okay, so that's that. So we have calculated, and then so now the TCR just similarly. So now it will be 600 plus 100 plus 200 tier 2 capital. That comes to 900 million. 900 now divided by 12 billion. 900 million divided by 12 billion. So 900 million divided by 12,000 million comes to
Oh, 7.5.
7.5. 7.5. So now it should be not below 8%. So now the National Bank of Malawi in this regard is not also complying with the total capital requirement side of the Basel 3 requirement. So we have seen that an increase of the risk-weighted assets of the National Bank of Malawi by 2 billion, from 10 billion Malawian kwacha to 12 billion Malawian kwacha, it put pressure on the National Bank of Malawi's capital ratios, e.g. the CET1 ratios, the TCR ratios, but there's even also the other liquidity management ratios, such as the other liquidity and capital adequacy ratios, such as the LCR and also the NSFR. And these fell, so now an increase led to the CET1 falling below 6% to 5.83, and also the TCR falling from 8% to 7.5%. Therefore, to meet the Basel III standards, the bank will need to raise additional capital or either reduce their assets.
Yeah.
Exactly. So they have those two options. Either they raise additional capital by conserving capital. They can also conserve capital and fail to
pay dividend.
pay dividends. That's also a method of at least like conserving capital or raising additional capital. Therefore, to improve their capital adequacy ratios and ensure they meet the three Basel III requirements. So that's the first part of the. So let's look at the two other additional conservation buffers and also the countercyclical capital buffers. So we said that the countercyclical buffer we also need it's an additional 2.5% on top of the CET1 that needs to be maintained, especially during market downtimes. Okay, so essentially it is 2.5 plus 4.5 that already needs to be there. That's around 6, right? 7.
Yeah.
7%. So the capital conservation buffer needs to be equal to or greater than 7% of the risk-weighted assets. But we said that this is usually enforced during market downtimes to ensure that banks, such as commercial banks, maintain sufficient capital to be able to survive period of economic distress. So even if we go back to, let's say, Malawi is the country or economy of Malawi is undergoing economic distress, and so now the Reserve Bank of Malawi will come in and ask that all banks, including the National Bank of Malawi, maintain an additional 2.5% on top of the CT1 that they are already required to meet in terms of the inner capital conservation buffer to be able to go through this period of market downtime. Will the National Bank of Malawi survive? Okay,
What?
7%. So in the first instance, if their risk-weighted assets remain at 10 billion, they won't. But if their risk-weighted assets come to now, obviously they won't,
Yeah.
because the ratios kept reducing.
Yeah.
So they need to hold additional. I think they need to raise additional capital, or at least conserve capital, or at least increase their risk-weighted, or reduce their risk-weighted assets in order to meet those requirements during such periods of economic downtime and economic distress. Okay. So how much will they need to raise? Okay. So to calculate how much the bank, so now as a treasury department, you can now calculate. Let's say we said the new assets were rose by 2 billion to 12 billion, right?
Yeah.
But then so we are assuming hypothetically that this is during a period of economic distress in Malawi. Therefore, instead of 4.5, they are required by law to maintain at least 7% of their risk-weighted assets as CET1. So 7%. So we calculate 7% of the new risk-weighted assets to get down what they currently hold at CET1. So once we get that what they currently hold at CET1, then we can know what they need to additionally raise. Okay, right? Because of from what they already do from their balance sheet, their hypothetical balance sheet that we drew. So 7% of 12 billion, right? Because that's exactly what ideally what the RBM requires them to maintain or to hold. That abbreviation RBM is funny because my boss at KCB was called
Right.
is called RBM, yani the regional business manager of cost.
Oh, okay.
Yeah, she's called Madam Jane Isiaho, so it's funny.
Mm.
RBM, the Reserve Bank of Malawi. So 7% of 12 billion. That comes to 7 times 12, that's 84. So 84
yeah.
million. 840. 840 million, right? 0.8 billion. Malawian kwacha.
Yeah.
So 840 million. But in their quarterly disclosures, what did they disclose that they have in terms of CT1?
They said
600. So meaning they are during this period of economic distress, for example, KCB, let's say KCB Bank in this case, which actually happened, you can look it up. KCB for the first time they didn't pay dividends in almost decades. Okay. Let's say KCB Bank, we agree maybe it was during elections, so there was economic downtime in Kenya. Okay. So now the Central Bank of Kenya came in with the additional capital conservation buffer requirement as part of the Basel III requirements that KCB needed to maintain not only 4.5% of their RWA, risk-weighted assets as CET1, but also an additional 2.5%. So total of 7%. So 7% of, let's say, the KCB's assets were 12 billion Kenya shillings, which is almost,
Very low.
yeah, is a tenth of what it actually is. They yield around almost 2 trillion Kenya shillings. So that comes to 840. So KCB were required by the CBK, Central Bank of Kenya, to hold 840 million. But see, KCB Bank, in their annual or latest disclosure, said that their CET1 was only 600 million. Therefore, what did the Treasury Department at KCB Bank do? They said, how are we going to rate the deficit? That is 240 million. How are you going to raise? There are three options. Either they could either raise additional capital, reduce their assets, and reducing assets. So for example, you liquidate some loans, things like that, or reduce your provision for NPLs, non-performing loans. Okay, and the third option that they had was to conserve capital, and then they went for the third option, that is conservation of capital. They failed for the first time to pay dividends, and paying dividends or retained earnings, and they opted to retain earnings as part of the CET1 is also composed of retained earnings,
Yeah.
plus the common equity. Yeah, so they opted to retain earnings, and I believe so. The figure that they wanted must have been 240 million, at least in our hypothesis here. Yes. The last one, that is the counter-cyclical buffer. We say this one is only during capital expansion to prevent banks from overlending. But it is, as you said, it is a variable and it can always be varied by the countries, for example, regulators, the CBK, Treasury, things like that. And it's usually at a rate of 0 to 2.5% of the CET1 capital as additional, depending on the nation of the, or the countries, and how they, for example, the CBK or the CBK's monetary policy framework and department analyzes the country's financial stability, especially during politics when or things like that. I mean, when there is high inflation. So it is especially implemented during periods of credit booms. A period of credit boom, people tend to borrow a lot. Let's say the interest rate, the base lending rates come down, so people borrow a lot. So it's usually enforced then to be able to force banks to not lend at, because when they have too much capital at their disposal, okay, then they lend a lot. So CBK comes with this counter-cyclical, like counter-cyclical meaning a cycle, cyclical, yani cycle to counter that cycle of credit boom, for example, or loans boom. Okay, so it's an additional. So in this case, so the CT requirements, for example, let's say an example of Kenya. Let's say Kenya is undergoing a period of credit boom, people are borrowing a lot, but the CBK wants to counter that, okay, in a counter-cyclical buffer move. So let's say in addition, we said it can be even 2.5 in addition to the CT1 requirement. Okay, just as the additional counter, what was it, capital conservation during downtimes is usually 2.5, but this one can be varied. Either CBK can come up, let's set for this bank to 2% in addition to the 4.5. So let's say they say it's not there is a period of credit boom. Let's set for this commercial bank as the CBK's monetary policy. Let's set for them an additional 1.5% in addition to the 4.5 that they need to already maintain. So 1.5% plus 4.5%, that comes to 5%, no, 6%. So in addition to the 4.5, or instead of say 4.5, commercial banks in Kenya now need to maintain 5 no 6% CET1. Okay, and therefore in that regard they will be restricted in overlending. Okay, so 6%. So to get now what they now will need to, the new or the additional capital they'll need to retain, so we just multiply the 6% by the new assets. That 6% times 12 billion, that's around 5, right? 5%. I mean 50, what, 500 million.
6 by 12.
6 over 12 times 100, that's 500 million. And they had 600, meaning they need to raise an additional 100. Okay, right?
Yeah.
Exactly. Yeah, so let's look at now the last concept and now the Basel III framework, to see what challenges some treasury departments of certain banks and reserve banks may face in enforcing some of these Basel III requirements. Let's say there is a decline in asset quality. We said that one of the main components of the Basel III requirement is the risk-weighted assets of the. So let's say there is increasing risk weight of the assets. So meaning the asset quality declines. Therefore, when assets to banks is like includes loans and also an investment. So meaning loan quality declines. Therefore, when their loan quality declines, their risk-weighted assets also increases, and the ratios will also reduce. The capital ratios will reduce.
Yeah.
The capital ratios CET1 and also TCR and also CET1 plus AT1, right? And also even during, let's say it's a period of economic distress, then therefore the bank's earnings, as we saw, for example, if it's a period let's take even the exact example of an actual example that happened, KCB Bank, their earnings reduced. Actually, if you Google, just look up when KCB reported that they were not going to pay dividends for the first time in very many years, it was actually their earnings reduced. Their part profits after tax reduced. I don't know from, can't remember the exact figure, but it was termed over very many Kenya shilling billions.
KCB not
Paying dividends. Have you found it?
in 2023, which considers KCB's group announcement that it would not pay a final dividend in respect of 2023 earnings as a positive development. That will enable KCB Bank Kenya to preserve its current modest
Fitch is that banking regular. I know about it.
rating agency
Yeah, banking rating.
above the
In fact, they are called what and Fitch. Alan and Fitch something.
Okay, I don't know.
They are called something and Fitch.
So dividend pause and National Bank Kenya will sell. Okay, so the dividend pause and then they're also selling.
Exactly. Yes, yes. You can come in.
It pause.
No. Oh, we closed. I didn't know.
So we locked.
Thank you. Can I kindly have two, please? I talk a lot.
Let me just check this.
All right. Thank you.
Oh, now we have to cut.
I'm thinking of a whole different thing.
Oh.
There is an a very big American luxury clothing conglomerate and group called Abercrombie and Fitch.
Oh yeah.
That was Yeah, it's just Fitch. The banking rating agency is just Fitch.
Yeah.
Yeah. So they praise KCB for that move, right?
Yeah.
Yeah. So yes, actually it was because their earnings reduced. Their part, their profit after taxes reduced actually, and it
Okay.
was mainly because of NPLs. Hey, it was a period of almost all the banks provisions for NPLs
Way high.
where they provided higher than they usually do.
Okay.
It was not just KCB, though KCB is the only one that went as far as not paying dividends.
mm,
Uh, Another one is just what we just talked about, like their provision for dead, no, provision for non-performing loans increases because they have to now provide for more. It's usually during such economic downtimes and distress
yeah.
that you find that there are things like credit rates and
Mm,
hence default risks leading to increased NPLs by banks, and therefore increased provision for dead loans, and therefore reduced profitability. It's just one cyclical and correlated circle. Okay. And even during that period, not many people will even subscribe. They even there, by there I can't remember. I think their share price fell.
yeah.
Most banks and most companies, when they announce such things, that they are, for example, their part fell, or they provided more for NPLs, or they are not paying dividends,
Mm,
how they communicate that to shareholders is very, very key. I mean, you are telling shareholders you're not going to pay them. Even new people who want to subscribe to your shares,
yeah. They can
very
be
big.
put off.
Yeah, so you can banks can even they can struggle to raise
Mm,
additional capital. As we were looking at, that's one of the way of restoring the Basel III compliance. Yeah. So they may even struggle in doing that.
okay.
Yeah.
Also, Access Bank is from Nigeria.
Yeah, Access Bank is a Nigerian bank. They are now buying KCB's subsidiary in National Bank. Mm.
Are they
But
already present here, or they want
yeah,
to
Access Bank.
use?
No, Access Bank. I think yeah, Access. There is an Access Bank branches in Nairobi. I've seen.
Okay.
Yeah, Access Bank. Yeah, they are. Okay, so I think. Do you have any question up to that point?
Bang.
Okay. So then, in this case, we have seen a little bit of stress testing where the bank's assets increased by 2 billion to 12 billion, and then we saw how the bank was able to respond in such, and how their capital adequacy ratios was able to, for example, reduce. And we have seen now what options lie at the bank's disposal to be able to correct their compliance to the Basel III requirements by the country's reserve or commercial bank. So let's look at some of the, for example, now how we can do stress testing in such a situation when there are, for example, let's say market downtime, economic distress, market shocks, bank run, things like that. So we can do, for example, stress testing we can do, for example, maybe on just one variable. Let's say we can in this case we just hypothesized a worst case scenario of the risk weighted assets increasing by 2 billion. Let's say we also increased, also at the same time we hypothesized that the common equity also, or equity markets, there was also a decline or a surge in the equity markets, and then therefore we can be able to how that will impact the 600 million, and therefore what the new ratios will be. Okay. Yes, that's usually called yani just one line of stress testing. But then we can also stress test using different variables. Okay. What else I want to tell you about? Hmm. And then also we have seen about the implementation strategies. I mean, or what now? What options lie within the disposal of the bank to be able to restore such, or when they do the stress test and they find that they are not compliant, what can they do? One, we have said they can capital buffers through retaining earnings or issuing new shares, which though they may struggle, but they can still. So just basically raising new equity or additional equity. They can also reduce their, for example, NPL. Okay, by the way, banks. I told you banks started lending to at a risk-based premium.
Yeah.
We call it RBP, at a risk-based premium. Okay, so that's one way of reducing the exposure to risk. For example, interest rate and also credit default risk. So they can reduce their risk exposure by lending to just certain sectors of the economy or to certain customers that are less risky. Or there is there something called CRB in Malawi?
See what?
CRB, Credit Reference Bureau.
Oh yeah,
There is.
it's a new thing. Yeah.
In fact, before you are hired at a bank, your credit rating needs to be very good.
Mm.
Mm. Yeah, so the bank can also make advantage of that, make use of that, take advantage of that, or make use of that by lending only to customers that have good credit rating. They can also even cut costs. KCB sent, you can even look it up. KCB sent people on, it's called VER, a voluntary early retirement, like firing. Or another thing, what they actually did, failing to pay dividends.
Yeah.
Or skipping the dividends. So those are some of the mitigation strategies at the disposal of the Treasury Department of banks to be able to correct their compliance to the Basel III requirements of CET1, and also especially during market downtimes and also economic distress, especially on capital conservation buffers and counter-cyclical buffers.
Which downgrades three Kenyan banks following sovereign downgrade. That is one.
I want us to look at a scenario, just like a case study. Okay, let's say KCB Bank has a loan portfolio. The loan book of KCB is 1 billion Kenya shillings. Their NPL, what is called PAR, portfolio at risk, or the default rate, they can easily calculate that. Okay, let's say the 30 day or 60-day default rate is, let's say, 2%. Okay, but during stress testing, okay, during stress testing or during economic downtimes or economic distress, there is credit default risk. Let's say from 2%, the new default rate is 7%. Okay, and then also, so now, mhm, let's also assume, for example, each loan is about 50,000. The average size of their loan book or of each loan, and each customer has borrowed 50,000 Kenya shillings. Therefore, what that means that it let's say it's also, we also need to calculate their also hypothesize their current disclosures in terms of their equity, right? Let's say CET1 they have 500 million, 81 is still 100, and also T2 200. Okay, then so now let's try to do an hypothetical stress testing. So we have done stress testing to see that the default rates during an economic downtime or economic distress rises from where it usually is at 2.2%. By the par is usually needed to be below 5. Okay, most banks,
Okay.
yeah, right? Yeah, but portfolio at risk, the value, the default rate. But so now, let's say they simulate a worst case scenario, that default rate rises to even to 7, as it must have for them to even increase their provisions for bad debt. Therefore, we said that they have 1 billion That's the average size of their loan book. So what's the default rate of that loan book? We said that now from 2% to 7%. So 7% of that loan book. Cindy,
Yeah.
7% of 1 billion, around 700 million, right?
No.
70.
70.
70 million Kenya shillings only. So 70 million is at risk. That's the portfolio at risk. Okay. The total value of defaults. Okay. Therefore, and we said that the expected loss from these defaults is each each loan each loan was, let's say each customer took 50,000, right? But the value of the default is 70 million. So the expected loss in this scenario, in this worst case scenario, is 70 million times 50,000. That's almost 3.5 billion, right? 3 see 70 times 50. 7 times 5, 35. 35 billion or 3.5 billion. 3.5, right? Let me just do it. Mm. So 70 m by 50. This is 3,500 million, obviously. So 3,500 million, that's 3.5 billion. So that's the worst case loss. Or in a worst case scenario, that the default rate rise from all the way from 2% to 6%. So let's say, mm, therefore, if their loan book was, you said their loan book was 600. Let's still take just the Nini hypothesize that this was their loan book, 600 million.
Okay.
So if their CET1 was 600 million and the expected loss is now 3.5, then they have a negative in their loan book, right?
Yeah.
So this means that the bank has a negative CET1, negative of almost 3.5 billion. No, so 3.5 minus 500, so almost 3 billion, right? Which is far below the Basel 3 requirement, shouldn't be negative. Therefore, KCB Bank would, in this case, be in breach of the Basel 3 requirements by the Central Bank of Kenya. But this is just thank God it's just a stress testing. So now what can KCB do? I'm just trying to recap what we just talked about. So what can KCB do in this in this case? Exactly what they did. They increased their provision for bad debts. They introduced, for example, lending at a risk-based price, okay, and only lending to riskless borrowers. And also they conserve capital. Also they try to issue new capital just to try to increase their capital adequacy levels. They can even decide to not pay dividends, that or skip dividends. So yes, those are some of the what exactly in a stress test scenario the Treasury Department can do. So yes, is there anything? Is there anything you